So let's continue. We want to continue from where we left. We had started this topic of published accounts in our first lesson. Today is our second lesson. So let me review the topic first before we continue. We had said this. When you're a public company, you are required to prepare published accounts. And so we asked ourselves, when you as a public company are required to prepare published accounts, what should you include in a complete set of financial statements for publication to the public? And we said there are 5 components that should be included in a complete set of financial statements. One is what we were calling a statement of financial position, which we were calling the same as balance sheet. Number 2, we were saying you're supposed also to include a statement of profit or loss and other comprehensive incomes. 3, we said you're also supposed to include what we were calling statement of changes in equity. Number 4, we said you are supposed to include a statement of cash flows. And number 5, you are supposed to include a statement of, accounting policies and explanatory notes. Accounting policies and explanatory notes. Now listen. So we said how you prepare these documents for publication purposes is slightly different from the way you as a company, you prepare them for internal reporting. In other words, the way you used to do financial accounting, like the statement of financial position or an income statement, which is also called statement of profit and loss, how you prepared it when you are doing financial reporting, financial accounting, is slightly different than when a company is preparing this document for publication purposes. Last time, we had introduced how do we prepare an income statement, or what we are calling a statement of profit or loss for publication purposes, for publication to the public. How do you present it? There are some rules we looked at and we said they should be adhered to when you are preparing this document for publication purposes. So we said this. Let me review just a little. We said this. When you are preparing an income statement for publication purposes, we said you start with the normal sales. How much are the sales? Then we said you come to cost of sales. One key important point we said when it comes to cost of sales is this. We said you as a company, you are not required to show the workings of the cost of sales. You are not required to show the workings of the cost of sales on the face of the income statement. We say do that calculation somewhere as a working and bring it as a single amount. That was an important point. That for publication, don't come and tell us opening stock, add purchases, less closing stock on the face of the income statement. No. We say do that calculation somewhere, bring it into the financial statement as a single amount. Good. Then we said you get the normal gross profit. That's what we said. Then we said you are supposed to minus expenses. But then you don't minus them the way you used to minus them when you are doing financial accounting. In financial accounting, you have to minus you have to minus insurance, telephone, electricity, water, salaries, and so on. But for publication purposes, we said you are required to classify the expenses according to the function that they perform in an organization. We said there are 2 categories of functions that may be performed in an organization. One of the function we said is administration function. So go through the question and find out which expenses does this company incurred, which can be classified as administration expenses. All those expenses that are related to administration. Combine them again. Listen, combine them again somewhere. We said you bring them again as a single amount in the income statement. Don't show them again on the face of the income statement. No, but work them out somewhere. We gave examples like electricity of the office. We normally use office for administration. Salary to the office workers, that's an admin expense. Maybe rent of the office, and so on. Depreciation of office equipment, and so on. Combine them somewhere, bring them as a single amount. Then from there we said you also come to the second category of functions. That is what we were calling selling and distribution expenses. We said again, as a company, combine all the expenses that are of selling and distribution in nature, combine them somewhere and bring them in as a single amount, We gave examples like advertising, maybe salaries to the sales manager and the sales workers, maybe depreciation of delivery van, maybe bad debts. These are expenses that are incurred in the process of selling or distributing the goods that you are selling. That's what we said, you combine, you bring them again as a single amount. Once you do that, we said you get the net, and that net is what we were calling profit from operations, Then from there we said you are supposed to minus what we were calling finance cost. I discussed some details concerning finance cost, though we shall repeat a few of those, but in our previous class we discussed. We said one example of finance cost is the interest expense. We gave examples like interest on debentures, interest on loans, and so on. And we also went further and looked at how to calculate the interest charge, not the interest paid. What you take to the income statement, we said, is the charge for the year for interest, not what you have paid. Why? Remember I said, when you are preparing your financial statements as a company, we follow a concept that is called accrual concept, which states that you recognize costs when they are incurred, but not when they are paid. So it's not when you paid the interest on debenture. It is when did you incur and how much. So it is the amount you incurred this year that you charge. I'm not going back into the details of that, but we discussed that in details. Then from there we said you come to the next item called investment income, either in form of dividends. As a company, you could have some investments which are earning you dividend, or there are investments you have which are earning you interest income. Maybe you have bought some treasury bonds, they are earning you interest as a company, or maybe you have bought some treasury bills, they are earning you interest. They are investments and they are earning you income in form of interest. Good. Then from there, tukasema you get a net amount which we called profit before tax. Then we said you minus the tax. Listen, we said to minus the tax, you take the normal current tax, which you are normally given in a question. We said it's either called current tax, or a question may call it corporation tax, whatever it is. Then we said you adjust it with the amount we were calling deferred tax. I said deferred tax is an amount that either you add it to the current tax amount, or it's an amount you deduct it from the current tax. We shall look at that in details. How do you know which ones to add and which one to minus? Good. In terms of deferred tax, once you get the tax expense, you minus from the profit before tax, and we said you get that figure we were calling profit after tax. Good. I also need to remind you, listen, we said when you're doing financial accounting in the previous level, we said you remember you did the topic of company accounts, and in that topic, once you got the profit after tax, we had to say, or we said you had to appropriate that profit. In a company, we said you normally appropriate the profit by paying dividends, transferring part of the profit to the general reserves. You remember, then getting what we were calling retained profit for the year. Then we were normally adding retained profit brought down to get what we were calling retained profit carried down. But listen, for publication purposes, which is the topic we are doing, we said that when it comes to income statement for publication purposes, you don't do those appropriations in the income statement. No. we said you do them where? We said you do them in another statement we were calling the statement of changes in equity, where we said all appropriations are normally done in the statement of changes in equity. Okay, we shall look at that in details. How do you prepare it? But that's what we said. Listen, then I told you, when a question tells you required, A, prepare an income statement. It means you will stop. You will stop after getting this figure we are calling profit after tax. But then I told you, if the question tells you prepare a statement of profit or loss and other comprehensive income, then we said it is at that point that you now come and disclose what are the other comprehensive incomes that your company could have made. I told you, listen, I told you, these are incomes, other comprehensive incomes. These are incomes you have made as a company, but the rules or the accounting rules for them don't allow you to take that gain to the profit or loss. But yet it's a gain you have made as a company. So we are saying you are allowed to show them as part of other comprehensive incomes. And we gave an example of gain on revaluation of a fixed asset. Remember I told you, when you revalue a fixed asset, maybe land, building, motor vehicle, and you revalue it upwards, maybe the asset had a book value of 100 million, you revalued it upwards by 20 million. Listen, we said you normally debit asset and credit an account called revaluation reserve. You normally debit asset and credit an account called revaluation reserve. That revaluation reserve is a gain. But the rule did not tell us to debit asset and credit P&L account with the gain of 20 million. No. But the 20 million we made this year is a gain. But the rule for that double entry does not say you debit asset, credit P&L. It says you debit asset, credit revaluation reserve. And that revaluation reserve goes direct to the balance sheet. But is it a gain that a company we made? Yes. Does it go to the income statement? No. So you as a company now, you can tell the readers of your financial statement that we have other comprehensive incomes. Examples being gain on revaluation of fixed asset. We give another example, gain or what we are calling exchange difference on translation of foreign currency transactions. I don't have to repeat that. Then once you have shown your other comprehensive incomes, whichever they are, we only gave a few examples here. We only gave those two. Then you get the total, and that's what we are calling total comprehensive incomes. Then, listen, we looked at this thing I've called here preference shares. I asked you a few questions in the previous lesson, but let me review because that's where we stopped. And that's where we want to continue. That's where we want to continue. So let me now, like I am continuing from where we stopped, because we did not write the summary notes on this. We only wrote the notes on the other, but we never wrote the notes on preference shares that I want to review. So allow me to review, because I've reviewed everything, but we stopped at this point. Now listen, we say when you as a company want to raise finances, you can issue preference shares. And we said there are normally two types of preference shares that you can issue. You can issue a redeemable preference share, or as a company, you can issue a non-redeemable preference share. Let us assume company A issued a 10% redeemable preference share worth 30 million, while company B raised capital by issuing a 10% non-redeemable preference share worth 30 million. So the question was, listen to this now, the question was, when you as a company, you are preparing the balance sheet of this company, will you take this 30 million for the two companies in the same place? Will you take the two amounts? If company A issued a 10% redeemable preference share, worth 30 million, and company B issued a 10% non-redeemable preference shares, worth 30 million, will you take the two amounts in the same place in the balance sheet? The answer was what? No. The answer was no. That when you are preparing the balance sheet of these two companies, the two don't go to the same place in the balance sheet. No. First, we distinguished what's a redeemable preference share and what's a non-redeemable preference share. I said, and of course you know, redeemable preference means if 10 years ago the company issued these preference shares and they issued them then as redeemable, it means, listen, it means that your company one day in the future will be required to redeem those shares. In other words, pay back those shares. That's what we call redeemable preference share. The company will be required to pay back the 30 million. But if your company issued a 10% non-redeemable preference share, maybe 10 years ago, 5 years ago, the question is, does that company have an obligation to pay back the 30? The answer is no. So we said company A has an obligation to pay back the 30 million. When they issued a 10% redeemable preference share, then you as a company A, you have an obligation to pay back that 30 million to the shareholders in the future. While company B does not have any obligation. Therefore, listen, therefore we say, because you company A, you have an obligation to pay back the 30 million, you will take it to the balance sheet. Listen, you will not take it to the balance sheet as part of capital. The 30 million for company A, no. Why? Because to them, it's a liability. They have an obligation to pay back. So we said the 30 million for company A will be taken to the balance sheet as a financial liability. The company has an obligation to pay the 30 million in the future. So in the balance sheet, among the non-current liabilities, that's where you will take the 30 million for company A. But for company B, because they have no obligation to pay back the 30 million, we said you will take them, you as company B, you will take your 30 million as part of capital in the balance sheet. Meaning, among the equities in the balance sheet, where you will now have ordinary share capital, share premium, general reserve, revaluation reserve, those are components of equity. Among them, that's where you now bring in the non-redeemable, the 10% non-redeemable preference, the shares, the 10% non-redeemable preference share. It's part of equity. Are you there? It's part of equity. That is important. How they affect the balance sheet. One of them is a long-term liability. The other one is considered as part of equity. The other one is considered as part of equity. Hope you have understood that. Now, listen again. Both companies issued a 10% preference shares amounting to 30 million. It means, listen to this, it means both companies are required to pay their shareholders a dividend of how much every year? 3 million. Company A will be required to pay 3 million to the preference shareholders. 10% of 30 million is 3 million. Company B, the same, 3 million. Now the question was, listen to this now. Now the question was, this 3 million for company A, will you take it in the income statement in the same place like you do for the dividend of company B? Listen, we said the answer is no. You don't treat the dividends on the two companies the same way. You don't treat the dividends of the two companies the same way. We treat them differently. Let me remind you. Company A has issued a 10% redeemable preference shares. And I've already told you it will go to the balance sheet as a long-term liability, where you normally have maybe something like 10% debentures. There you will have a 10% redeemable. Now remember, interest on debenture is a finance cost. Interest on debenture is a finance cost. Why? Because you borrowed. And the cost of borrowing is the interest you paid on the debenture. So interest on debenture is normally considered as a finance cost. That's why when we were preparing the income statement, we said one example of a finance cost is this amount we are calling what? Interest expense. Okay? Good. Now, when it comes to preference shares, if the preference share is redeemable, like company A, remember for them, their preference share is not a capital. It's not part of capital. It's a borrowing. They have borrowed. It's a liability. So they have it among the long-term liabilities. So they are borrowing. Okay? And the cost of borrowing is the interest or the dividend you pay. So for redeemable preference, what cost does it cost you to borrow? It costs you the dividends you are paying. Now listen. So the 3 million dividends on the redeemable preference share, that 3 million will not be considered as an appropriation of profit. The way you normally say profit after tax, then you minus dividends. This time you don't minus that dividend from the profit after tax. No. Instead, you will consider it as a finance cost. Instead, you consider it here as a finance cost. That's why when we were discussing this thing last time, in our lesson number 1, we see another example of a finance cost other than interest is preference dividends. And dividends on which kind of preference shares? On the redeemable preference shares. Okay? Now listen. What if this company B, what about the dividend of company B? Company B issued a non-redeemable preference share, which is worth 30 million. Again, every year, they are required to pay their shareholders a dividend of 10% of 30 million, which is coming to how much? 3 million. Remember I told you, non-redeemable preference shares are part of equity. They are part of equity in terms of, in other words, they are part of capital. So the dividend, now listen, the dividend that you pay to the non-redeemable preference share, the dividend that you pay to the non-redeemable preference share, that dividend should be considered as an appropriation. It should be considered as an appropriation of profit. Listen, where you normally say profit after tax, then you less dividend, whether on ordinary, on preference, that's where you minus the 3 million on the non-redeemable. Now that we are preparing published accounts, I said you don't appropriate the profit in the income statement. I said you appropriate the profit where? In the statement of changes in equity. In the statement of changes in equity. This is where the 3 million will go as an appropriation of profit in the statement of changes in what? In equity. So, whenever you are given a question on published accounts, listen carefully. the first thing, once you realize from the trial balance that they have preference shares, you have to ask yourself, what kind of preference share do we have? Do we have redeemable preference share, or do we have a non-redeemable preference share? If you issued a non-redeemable, like company B, then I'm saying, when you are preparing the balance sheet for that company, show it as part of equity. But if from the trial balance you realize the question tells you we issued a redeemable preference share, then I've said, in the balance sheet, show it as part of long-term liability. That is part of non-current liability. That's one point. Point number 2, tumesema, how do you treat their dividends? Different. Tumesema, any dividend on redeemable preference share, it should be considered as a finance what? As a finance cost. Why? Because you are borrowing these finances. It should be considered as a finance cost, where in the income statement. But any dividend on non-redeemable preference share, that should be treated or considered as an appropriation of profit in the statement of changes in equity. I hope we are through, or we have understood that important point. Okay? This time you don't just treat preference shares anywhere. No, that is commonly tested. In other settings, you find the examiner having brought redeemable. In some settings, you find the examiner having brought non-redeemable. So you must be careful. I hope we are all together. Somebody to comment whether we are together there concerning redeemable or they are non-redeemable. Are we together so far? Somebody to say yes or no. I want to hear the comment there, because it's important. Any question you get, it will either come with a redeemable or non-redeemable. Good. Somebody says good. Yes. So I think last time, good, we are together. Thank you. Now listen. Last time, which is in our last lesson, we were to write the summary notes. I've just reviewed what we discussed last time. But what was remaining was to write the summary notes on that preference share. So let's put down, because it's now a continuation of lesson 1, let's put down the summary notes on that. So have another subheading, preference shares, or you can say it, treatment of preference shares. Put it that way. Andika subheading, treatment of preference shares and preference dividends. As a subheading, put it down, treatment of preference shares and preference dividends. Treatment of preference shares and preference dividend. Treatment of preference shares and preference dividends. Treatment of preference shares and preference dividend. Then you say this. Then you say this. In our lesson 1, we had written summary notes. Go back to the group. Go back to the video I posted to you. There is that summary. Michael, go back to the group where the link for lesson 1 is. If not, we shall discuss it next time. I'll give the notes, but I know video number 1, lesson 1. Go back to the group or the video I posted to you for lesson 1. Not the free class of the other day. I'm talking of the lesson for the class. The one I posted to the group or to the individual. Okay? You have the lesson 1. You have the lesson 1 video. You have the lesson 1 video. That's the one I'm referring to. Okay, sir. I was referring to the, no, not the free class of yesterday. It is the normal class video. Good. So go back to that class video. Yesterday was just a free class. We did not even discuss this yesterday. but in the normal class of the other time, we discussed it. Okay, so let's put down the summary notes. We have said treatment of preference shares and preference dividends. Then you say this: if preference shares are redeemable, 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 comma, they are considered as a long-term liability. If preference shares are redeemable, comma, they are considered as a long-term liability in the balance sheet. They are considered as a long-term liability in the balance sheet. They are considered as a long-term liability in the balance sheet. Will you stop? Go on. This is because the company that issued them, this is because the company that issued them has an obligation. This is because the company that issued them has an obligation to pay back that amount. This is because the company that issued them has an obligation to pay back that amount. To pay back that amount. Good. Another paragraph. If the preference shares are non-redeemable, if the preference shares are non-redeemable, of course some books will call them irredeemable. We are saying if the preference shares are non-redeemable, continue, they are considered as part of equity. They are considered as part of equity in the balance sheet. They are considered as part of equity in the balance sheet. They are considered as part of equity in the balance sheet. They are considered as part of equity in the balance sheet. They are considered as part of equity in the balance sheet. They are considered as part of equity in the balance sheet. Will you stop? Continue. This is because the company that issued them, this is because the company that issued them, this is because the company that issued them has no obligation. This is because the company that issued them has no obligation to pay back. Has no obligation to pay back that amount. This is because the company that issued them has no obligation to pay back that amount. Okay, that's all. Another paragraph. Another paragraph. Preference dividends. Preference dividends on redeemable. Preference dividends on redeemable preference shares. Preference dividend on redeemable preference shares. Preference dividend on redeemable preference shares are considered. Preference dividends on redeemable preference shares are considered as a finance cost. Are considered as a finance cost in the income statement. They are considered as a finance cost in the income statement. The 10%, that's what we are saying. So the 10% redeemable, the 30 million. Somebody is asking, which one do we consider as a long term? It is the 30 million that you considered as redeemable. Are we together? Anna, you are asking kindly, as long-term liability, which amount do we indicate? The 10% of 30, no, not the 10%. 10% of 30 million is the dividend. I'm talking of 30 million, the amount. The company issued the 10% redeemable worth 30 million. So 30 million is the one we are discussing, Anna, not 3 million. 3 million is the dividend, which is 10% of 30. Are you okay? Okay, you've got it. Thank you. So it is the 30 million. So we are saying, where was I? So I was talking of, listen now, let me review. I was saying preference dividends on redeemable. Preference dividends on redeemable preference shares should be considered as a finance cost. Should be considered as a finance cost in the income statement. Should be considered as a finance cost in the income statement. Should be considered as a finance cost in the income statement. In the income statement. Another paragraph. Preference dividends on non-redeemable. Preference dividends on non-redeemable preference shares. Preference dividends on non-redeemable preference shares should be considered as an appropriation of profit. Should be considered as an appropriation of profit in the statement of changes in equity. Should be considered as an appropriation of profit in the statement of changes in equity. In the statement of changes in equity. Should be considered as an appropriation of profit in the statement of changes in equity. Good. Fine. So let's continue from where we left with the other class now. Don't forget, we are not discussing of what we talked about yesterday. So those who joined yesterday for the free class, no, we are discussing the normal lesson 1 of the video. Good. Let me continue now. I'm still back. Let me explain. I'm still back on the income statement. Listen to this now. When I finished that dividend, then I said I will discuss this concept. Listen, I will discuss this concept of deferred tax. That one, we never discussed it in lesson 1. I want to discuss it. Just to discuss what is deferred tax and how do you know whether to add or whether to subtract. How do you know whether to add or how to deduct? Okay, good. Let me discuss it now. Let me discuss the treatment of deferred tax. Let me discuss the treatment of deferred tax. Now, deferred tax is a topic on its own. Deferred tax is a topic on its own. We shall look at it later as a topic of its own. But I just want to talk about how it affects income statement, because we are preparing income statement. But how to calculate it, that's purely a different topic. But your income statement questions will talk about, take this to the deferred tax, this amount, how to calculate it, that's different. That's a topic on its own. But let me discuss it here, because I talked about, when I was doing this format, I said, once you get the profit before tax here, once you get the profit before tax, we said you come and minus the tax. We said there are different types of taxes. One is the current tax, or what you can call the corporation tax. And number 2, you have what we call deferred tax. Corporation tax is not a big deal. It's normally what you pay out of your profits as a normal business. And it will always be given in the exam. Okay? So how to treat deferred tax is my concern for now. How to treat deferred tax is my concern for now. So let me discuss it now. What is it and how does it affect income statement? In other words, do you add it to the corporation tax amount, which is the current tax, or do you deduct? There are times you add, there are times you deduct. Now let me start. As a company, you made a certain amount of profit, whatever it is. Let us assume you made a profit of 100,000. If the tax rate is 30%, you will be required to pay, according to you as a business, you think you will pay 30 million or 30,000. Okay? But then, when you take this income statement to the taxman, he will not tax you on 100,000 profit that you have got. Why? Because the taxman follows his rules. You followed your normal accounting principles and concepts to prepare your income statement. But there are some rules that the taxman follows in computing how much you should pay as tax. Now listen. Suppose to the taxman, he calculates and says, you're not going to pay me 30 this year, you're going to pay me 25,000 this year, according to the rules of taxation. He calculates his profit, then he takes 30% of that profit and he says, now pay me 25. While I thought as a businessman I'll be required to pay 30, the taxman is saying, pay me 25 this year. Pay me 25. There's a difference between mine and his by how much? By 5,000. The question is this. Does it mean that as a company, I am not going to pay that 5,000? The answer is no. According to the taxman this year's rules, he says you pay 25. But according to your rules, you're supposed to pay 30. That does not mean, listen, that does not mean that you're not going to pay that extra 5. It will be required of you as a company to pay it in the future. Maybe the tax rules does say, the tax rule says don't pay that 5 now. You'll pay it in the future. So this year you'll just pay the taxman 25, whatever he wanted. But according to your rules, you should pay 30. Does it mean that you're not going to pay that extra 5? The answer is no. So what do you do as a businessman? Listen, you will be required to defer paying that 5 until a later date. You defer paying that 5 million or 5,000 until a later date. In other words, create a liability in your books now to be paid in the future. You create a liability now to be paid in the future. What you will do, you will transfer that 5 million to an account we shall be calling deferred tax. Good. It's a liability that you want to create. So you will open an account called deferred tax. Deferred tax is ideally that tax that you should pay, but in the future. The amount of the income tax payable. The amount of the income tax payable in the future. That's the one we are referring to as deferred tax. So you create a liability now to be paid in the future. Now listen. Suppose in the previous years, you also kept deferring. Come the beginning of this year, you still have a balance brought down by the beginning as a liability. Let us assume you have a liability balance brought down of maybe 40,000. Now this year, you are being required to defer another 5,000. Listen. So to defer 5,000, in other words, increase your liabilities to be paid in the future by 5,000. To make or to create a liability, of course, you know a liability is always a credit balance. So you'll credit this account by how much? by 5,000. Initially, you had been deferring paying 5,000, whatever it is, cumulatively. By the beginning of this year, you have a liability of 40, which is so far deferred. Come this year again, we realize they're still not asking me to pay another 5. Does it mean I'm not going to pay? No. Let me defer it. In other words, let me create another liability this year to be paid in the future. So I increase my liability by 5. I credit, meaning I'm going to debit P&L account by 5. So the double entry for that 5 is you debit P&L account. If you do it in P&L in a T format, listen, you do it in a T format, you know profit before tax. Profit before tax is normally a credit balance. The profit is always a credit balance. We normally pay taxes out of profit. So whatever is the corporation tax, we normally debit corporation tax or current tax. We pay it out of profit. So you normally debit corporation tax in the P&L. Let me assume the corporation tax this year was maybe, let's say 25 or 30, whatever it is. Let us assume whatever it is, that was the corporation tax this year. Maybe let's use 38. That was the corporation tax. But this year, you are transferring to the deferred tax. How much? 5. So you credit deferred tax. It means you debit P&L account. By how much here? You come and say your deferred tax. Sorry. This is deferred tax. By another how much? 5. That 5 you deferred, you credited your liability by 5. You have to debit P&L account. Listen to this now. The question is this now. If the corporation tax was debited, which is normally debited, and then I'm coming and debiting again the P&L account with another 5 million or 5,000, the question is, does it mean I am increasing the amount of the corporation tax or I'm reducing the amount? I have debited P&L account by 38 for corporation tax. But then I am debiting P&L account again by another 5, sorry. Does it mean I'm increasing the 38 or I'm reducing the 38? Somebody with an answer, tell me there. Am I increasing the 38 or am I reducing the 38? When I'm debiting P&L account by 5, am I increasing the 38 or am I reducing the 38? Somebody to comment. Somebody to comment. Am I increasing the 38 or reducing the 38? Good. Of course, you are increasing the 38. Now listen. When you are now preparing the income statement, don't forget we normally do it in a vertical format. Here. So I'm coming back here. Good. Here, our corporation tax was 38. Here. Now we have realized our deferred tax is another 5. So the question is, will I add that 5 to 38 or will I minus? We have agreed you will add. So the true tax expense here now will be 43,000. That's what you minus. Okay? Good. Now let's go back. Suppose, let's go back. So by the end of the first year here, listen, by the end of the first year here, you will carry down a balance of 45. You will bring it down by the beginning of the second year, balance brought down, 45. Now listen, suppose in another year, your calculation as a business, you thought you will pay tax of 25. But the taxman now calculates and says, you will not pay me 25, you will now pay me 28 in that other year. So while you thought you will pay 25 according to your accounting rules, but according to the tax rules now, the taxman says you will pay him 28. There's a difference of how much? 3 million or 3,000. The question is this: where will I get this extra 3,000 from? Yet as a business, I knew I should pay 25, but the taxman is asking me to pay 28. Where will I get this extra 3 million from? Listen, it is at this point in time that you now go and recall. You recall the 3,000 from where you kept deferring. Are you there? So this time, you will go and recall from where you deferred. In other words, you now transfer that amount from the deferred tax. Listen. So we know deferred tax, I've said, is a credit balance. Now I want to take from there 3,000. To take it from there, it is obvious I have to debit deferred tax by how much? 3,000. And therefore, I'll come and debit deferred tax by 3,000. I'll credit P&L account by 3,000 here. I'll credit P&L account here by 3,000. I'll come and say here deferred tax 3,000. Don't forget, the corporation tax did not change, or the current tax. It's an amount that we pay out of profit, so it will always be debited in the P&L account. But this time, listen, with the 3,000 deferred tax, I debited deferred tax by 3,000. I credited P&L account by 3,000. The question is, by me crediting P&L account by 3,000, while there is a debit of 38 on the debit of the P&L, the question is, am I increasing the 38 by the 3,000 or am I reducing the 38? It is obvious. Listen, it is obvious. When you credit an account which has a debit, it is obvious you are reducing the debit. You are reducing the debit. So when I'm recalling 3,000, I'm recalling it from a liability. The double entry is, I've already said, liabilities are always a credit balance. So to recall from there, you will debit the liability account, which is an account we are calling deferred tax, and you will credit P&L. That's a double entry. From here you can see that I am crediting P&L account with 3, but on the debit there is 38. So automatically you are reducing the debit. So when it comes to income statement now in vertical format, this time we are transferring 3,000 from the deferred tax. When I'm doing my income statement here, I'll come and say, what is the corporation tax? 38. What was the amount of the deferred tax this year? 3,000. The question is, will I add the 3,000 to the 38 or will I minus? This time I am deducting. So I minus 3,000. I get a net of 35. Good. So that's how we treat the amount of the deferred tax. You will either add or subtract. Listen before we continue. Now, I started by assuming that by the beginning of this year, the balance of the deferred tax was how much? 40. Then this year, I knew I should pay 30, but the taxman said I pay another 20. I pay him 25. So what did I do? I deferred the 5,000. To defer 5,000, listen, I had to transfer the 5,000 to the deferred tax. When you are transferring to the deferred tax, and deferred tax being a liability, to transfer it to the deferred tax, you will credit. That's why I credited deferred tax by 5,000. It means I had to debit P&L account. Are you there? Good. Now, there are various languages that the examiner can use to try to find out whether you know whether to add or subtract. One way he might tell you is this. As an additional information, he might tell you, transfer 5,000. Transfer 5,000 to the deferred tax. That's why I said, you know, if you are transferring to the deferred tax, you will have to credit deferred tax by 5,000. You will debit P&L account by 5,000. I said when you are debiting P&L account and there is already a corporation tax, you are increasing the debit. So you add. Are you there? Good. Still, Instead of the examiner saying transfer 5,000 to the deferred tax, he might tell you this: deferred tax to be increased by, deferred tax to be increased by 5,000. We began the year with 40. So if additional information says deferred tax to be increased by 5,000, then it means you go increase that liability. To increase that liability, you will credit by 5,000. Of course, you will debit P&L account. You credit deferred tax by 5,000, you debit P&L account. When you are debiting P&L account, of course, you are increasing the debit. That's one. The other one, let me use the 3,000 now. So the examiner may tell you, listen, the examiner may tell you as an additional information, transfer 3,000 from the deferred tax. Transfer 3,000 from the deferred tax. I've already told you, deferred tax is a liability. A liability is always a credit balance here. If I am saying this 45 is a credit balance, I'm required now to transfer 3,000 from the deferred tax. Now I come and debit deferred tax, I credit P&L account. That's a double entry. Then you obviously know when I'm crediting P&L account, when there's another debit on the P&L account, automatically I'm reducing the debit. Okay? So the examiner may tell you transfer 3,000 from the deferred tax. Alternatively, he might not talk of transferring from. He might tell you, listen, deferred tax to be reduced by, deferred tax to be reduced by 3,000. If he tells you that, you know deferred tax is a credit balance, whatever it is that the examiner will give you for the amount, which in our case here is 45, it's a credit balance. So if I'm now required to reduce the deferred tax by 3,000, you cannot reduce a credit by crediting again. You reduce a credit by debiting. So you will debit deferred tax by 3,000, and of course you will debit P&L. What I'm trying to say is that there are different languages that the examiner would use when he's trying to test you on this element or concept of deferred tax. Okay? So there is nothing we are going to write down as whether to add or subtract. It's just something that you should understand, so that when I'm doing a question from your past papers, we shall be using the double entry to understand. When they say transfer to the deferred tax, I know I'm going to credit deferred tax. It means I'm going to debit P&L account. And on the debit of the P&L account, there is already a corporation tax or current tax, so I'm increasing. When the examiner says deferred tax to be reduced by, then you know you are reducing a credit. Reduce a credit, you debit. You are debiting deferred tax, crediting P&L account. So there is nothing we are going to write down as a summary notes for that. No. Okay? Good. Just make sure you have understood the language of deferred tax. Good. I think now, listen, I think now I'm through with everything you needed to know concerning income statement, or what we are calling statement of profit or loss. Are you there? Good. Now let's go to the second component. We have now finished the discussion of how to prepare the statement of profit or loss for publication purposes. Okay? That is the most common one. Now let me discuss the first one, statement of financial position. How do you prepare it for publication purposes? How do you prepare it for publication purposes? So allow me now, before I discuss the small rules concerning balance sheet for publication, you all remember how you are preparing balance sheet for financial accounting. You know, listen, you know you have to start with non-current liabilities. This is balance sheet. Non-current assets, which we also call fixed asset. You have to come and show the land. What's the value of the land? Building. What's the value of the building? Motor vehicle. What's the value of the motor vehicle? Maybe furniture. What's the value of the furniture? And so on. Then you have to come to current assets, stocks, debtors, bank, creditors, and so on. Then you had to come to the other side of the balance sheet, equity and liabilities. You show the equities and you show the liabilities. Now listen. There's a slight difference on how you prepare the balance sheet for publication purposes as to compare to the balance sheet for internal reporting. I've shown you how you are preparing it for internal reporting. But for publication purposes, there is only one difference and a small difference. Listen. For publication purposes, you are not, listen, you are not required to show the readers of your financial statements that this was the value of the land, this was the value of the building, furniture, motor vehicle. No. You are not required to show in the balance sheet the individual components of your fixed assets, like machinery, land, building, furniture, motor vehicle, and so on, plant and machinery, and so on. No, you are not required to show them individually in the balance sheet. For publication purposes, it's not like you used to do in financial accounting. Now listen. For publication purposes, to present the fixed assets, or what you call the non-current assets, listen, you will be required to combine all your fixed assets somewhere. Combine all your fixed assets somewhere and bring them to the balance sheet as a single amount. Bring them to the balance sheet as a single amount under the name of property, plant, and equipment. You show them as a single amount. This is property, plant, and equipment. Bring them. You do the calculation somewhere. Combine the value of the land, motor vehicle, furniture, building, plant, and machinery. Combine all of them somewhere. Bring them as a single amount in the balance sheet and show it under the name of property, plant, and equipment. Listen to this now. Then, listen, if as a company you have any other fixed asset which cannot be classified as being part of property, plant, and equipment, yes, it's a fixed asset, but it cannot be classified as being part of property, plant, and equipment. Listen, that is the time now you show it as a single, you show them individually. Any other fixed asset which cannot be classified under property, plant, and equipment, that's the one you now show them individually. Which example can we give? Listen, when we say property, plant, and equipment, you remember when you did financial accounting, you did the topic of depreciation. And in that topic of depreciation, you usually had to prepare, listen, what we were calling fixed assets movement schedule. Some books will call it property, plant, and equipment movement schedule. You remember it? That schedule had various columns, and each column was for a particular fixed asset. The question now is, are there any fixed assets which a company may have, but they could never be used when you are preparing this fixed assets movement schedule? The answer is yes. There are some fixed assets your company may have, but they will never be shown in the fixed assets movement schedule, or what you can call property, plant, and equipment movement schedule. You remember you used to have a column for maybe land, building, motor vehicle, furniture, maybe plant and machinery, and so on. But are there other fixed assets that you as a company you may have, but they cannot appear under fixed assets movement schedule? Yes. Like which one? An asset like goodwill. You remember you never used to show it under property, plant, and equipment. But is it an asset, a fixed asset? Yes. So if you have such, you bring it here. That is goodwill, whatever it is. Another one could be investments. Maybe you have long-term investments. You have bought shares in Safaricom and you are keeping them for long-term. So any long-term investment, of course, it cannot be shown under property, plant and equipment schedule. No. Others would include things like other intangible assets, copyrights, maybe trademarks, patents. These are either examples of fixed assets or non-current assets which cannot be classified under property, plant and equipment. They are those that I'm now saying you are required to show them individually in the balance sheet. But for all the others which can be classified under property, plant and equipment, you are required to combine all of them into a single amount somewhere as a working, bring them into the balance sheet as a single amount under the name of property, plant and equipment. Then I've said any other fixed asset which cannot be classified as being part of the property, plant and equipment, that is the one that you now disclose it separately. I've given examples like goodwill, long-term investment, copyrights, trademarks, patents, and any other that cannot be classified as part of the property. Listen. Otherwise, the rest of the balance sheet for publication purposes remains the same as the other one for internal reporting. How you present current assets remain the same. How you present the equities and liabilities remain the same. Those ones don't change. They remain the same the way you know how to. The only difference I've said is how to present the non-current assets, or what you can call the fixed asset. Good. Maybe what we can do is to put down that summary statement concerning balance sheet. Have another subheading, statement of financial position. Statement of financial position. As a subheading, statement of financial position. Statement of financial position. Statement of financial position. Let me say this. Say this. All the fixed assets should be combined. All the fixed assets should be combined into a single amount. All the fixed assets should be combined into a single amount under the name. All the fixed assets should be combined into a single amount under the name of property, plant and equipment. Under the name of property, plant and equipment. Under the name of property, plant and equipment. Will you stop? And you go and say, any other fixed asset that cannot be classified, any other fixed asset that cannot be classified under property, plant and equipment, any other fixed asset that cannot be classified under property, plant and equipment should be shown individually. Should be shown individually in the balance sheet. Should be shown individually in the balance sheet. Should be shown individually in the balance sheet. E.g., goodwill, long-term investments, copyright, trademarks, trademark, patents, and any other intangible assets. And any other intangible assets. And any other intangible assets. Good. I'm through on how to prepare balance sheet for publication purposes. To finish, I want to go to the next component. We are still looking at how to prepare each of these components for purpose of publication. So let me now go to the next one. We now are through with the first two. We have said balance sheet, how do we prepare it? We have discussed the income statement. Now I want to go to the statement of changes in equity. How do you prepare a statement of changes in equity for publication purposes? So let me introduce it. Now, what's equity? Equity is anything that belongs to shareholders. So how do you present now statement of changes in equity? Now, a statement of changes in equity has various columns. A statement of changes in equity has various columns. Each column represents a component of equity. Let me assume one component of equity in your company was ordinary share capital, it's part of equity. Maybe you had share premium, part of equity. Maybe you have retained profit, part of equity. You have general reserve, part of equity. Maybe you have revaluation reserve. Revaluation reserve is part of equity. Normally, assuming those are the only ones, you normally have the last column for the totals. So I'm assuming from the question, those are the various components of equity as per your question. Okay, good. Then, listen, we are saying we are preparing statement of changes in equity. This year, what changes took place affecting the company that those changes affect our equities? So we normally start by bringing down the opening balance by the beginning. How much was our share capital by the beginning? How much was our share premium by the beginning? How much was our retained profit? How much was the general reserve? How much was the revaluation reserve? And the total equity at the beginning of the year. Now listen. Then I told you, when I was looking at the income statement here, I told you we don't appropriate the profit in the income statement. Here, I told you, once you get this profit after tax, here, I told you that profit should be appropriated. In other words, all the appropriations are done in the statement of changes in equity. Meaning, whatever you have got as your profit after tax in the income statement, you will now bring it so that you can appropriate it. You now come and say your profit after tax. You add it to your profit. Then you take it to the column of the total. It will increase the total equity. Then you appropriate it. By what? By things like dividends paid. This year, what did we pay as dividend? You appropriate it from the profit, you minus. That will also reduce the total equity. Maybe you are also told by the question, 20,000 was transferred to general reserve. So if there was a transfer to general reserve, you are removing the money from the retained profit, you minus, take it to the general reserve, you credit. So you are removing money from one form of equity, taking it to another form of equity. Obvious, that will not have any effect on the overall equity or the total equity. because you are removing money from one form of equity to another form of equity. Let me assume that those were the only appropriations out of the profit this year. But then ask from your question, find out from the question, are there any other changes that took place in our company this year which affects equity? Maybe yes. Like which one? Maybe during the year you revalued your land upwards. You must have debited land. You must have credited revaluation reserve. Revaluation reserve is part of equity. You come and say here, revaluation of fixed assets. Revaluation of fixed assets. You increase the asset, you must have debited asset, you must have credited revaluation reserve. Here, whatever it is, that automatically will also increase the equity. Good. Maybe during the year, you issued some shares. Shares will affect share capital. That's obvious. That's part of equity. Let me also assume that you did not just issue any shares, you issued some shares we call bonus shares. You did not issue shares by cash. You had to issue bonus shares. Let me remind you, this is not a new term to you. You know bonus shares are shares given to existing shareholders free of charge. That's why they are called bonus. Now you know this. Listen. Whenever a company issues shares, whether they are issuing them for cash or they are issuing them for free, that company must go and credit share capital. Whenever a company issues shares, it must go and credit share capital. If the company issued them for cash, the company must have debited bank, whatever it is, and they must have credited share capital. If they issued the shares for cash, they must have debited bank. That would be the double entry. But now the question is, what if these shares were issued for free as bonus shares? If they were issued for free as bonus shares, listen, then you as a company, you did not debit bank. But you must still credit share capital. Whether you're issuing the shares for free or not, share capital is increasing. So the question is this: which account will you debit? Because for every credit, there must be a debit. You know that's an accounting rule. And for every debit, there must be a credit. For every credit, there must be a debit. Now I've only credited share capital by whatever the amount of the bonus shares. So the question is, which account will you debit? Listen, whenever a company issues shares by way of bonus, that company will have to be required to finance the bonus from somewhere. They are normally required to finance the bonus from a reserve. That reserve could be share premium. That reserve could be general reserve. That reserve could be revaluation reserve. That reserve could be retained profit. All these are forms of reserves. So if the question tells you that the company issued bonus shares worth 20 million and these were financed from share premium, then you go debit share premium, you credit share capital. If the question tells you they were financed from the general reserve, then you go debit general reserve, then you credit share capital. So you must finance them from somewhere, and the question will tell you from which source the bonus was financed. Good. So let me assume that the question tells you that our bonus shares were financed from share premium. So we go remove the money from the share premium account here by debiting share premium, and you credit share capital. If they were financed from retained profit, I would have debited share retained profit. If they were financed from general reserve, I would have debited general reserve. But now we are assuming they were financed from share premium. I debit share premium by subtracting, I credit share capital. Does that have any effect on the overall equity? No. Good. Now listen, let me assume Now, those were the only changes that took place in our business this year, which affects equity. Once you're through now, you get the balances carried down. Balance these columns, get the balance carried down for the ordinary, get the balance carried down for the share premium, get the balance carried down for the retained profit, get the balance for the general reserve, get the balance for the revaluation, and the total equity. So in general, that's how we prepare a statement of changes in equity. It shows, that statement shows the movement in equity during the year. So let's put down that summary note. So have it as a subheading, statement of changes in equity. Have it as a subheading, statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Then you say this below that. Then you say this. A statement of changes in equity. A statement of changes in equity shows the movement of equity. Shows the movement of equity during the year. A statement of changes in equity shows the movement of equity during the year. During the year. Then you can say this. It has the following format. It has the following format. So I don't have to change anything in this format. Maybe you can just copy down this. So let me put dashes for where we had blanks. I'm just putting dash for where we had blank items. So copy that. Copy that statement of changes in equity. We have assumed there are 5 components. One being ordinary share capital, share premium, general reserve, retained profit, general reserve, and then finally column here, revaluation. Then you have another column for the totals. Then you start with the balance brought down. Each of the components, the question will tell you what were the balances. Then from there, go to your income statement, pick whatever you got as your profit after tax, bring it. Then you now appropriate it with items like dividends paid, transfer to general reserves, whatever it is, revaluation of fixed assets. Then you have bonus shares. Copy that. Copy. I hope you are through now.